Hey, this is Brent from TradeGuild.net. It is the 29th of September 2008. Remember this day, it was a historic one. If you were watching the market, you saw something that few people have seen in a very long time. Here's the Dow I have up on the screen. It's an intraday chart. You can see here's this morning and sell off right on the open. The market disliked the addition of three terms into the emergency rescue plan that they had worked on so diligently over the weekend. And the three terms the market disliked were: one, executive compensation limits; two, the ability of the government to hold warrants in the companies that were benefiting from the money; three, greater oversight. The market feared more or less that institutions wouldn't participate because of these three additions. And what's the point of having a rescue package if no one wants to use it? So we're looking at the Dow Jones 30. Let me show you a daily chart here. If we take a look at some trend lines, you can see a big bear flag back here in July through August. If we look at a 3-day chart, it's a little more clear. Here would be the flagpole, and here's the flag. This is a consolidation pattern that generally resolves in the direction of the preceding trend, which is down, which means this would go down. And we can derive targets in these patterns. And the target for the Dow Jones 30, the bear flag, you would say 12,500 is roughly where the flagpole started, and 10,800 is roughly where the flag ended over here. So we have about 1,700 points. You basically take 1,700 points off the breakdown, which would occur right in this area. What you'd be left with at 10,700, that's this area, you'd be left with a target of about 10,000. So we're almost there. We're at 10,355, coming 10,800 or so in this area. So we're almost there at the target of that bear flag. If we look at a 5-minute chart again, you can see that this sell-off in the morning was a sell-off. The magnitude of that was 300 points. This sell-off right here. And then what we've got is another consolidation pattern, which is another bear flag, actually. We'll talk about that in a minute. Today, the Fed, with 9 other central banks, increased the credit swap lines from $290 billion to $620 billion. So they raised it by $330 billion, coming from $290 billion. The Fed also increased their term auction facility from $25 billion to $75 billion, and that was to help shore up the credit markets. These are the 84-day sales. The TED spread, which is the difference between what banks charge each other for a 3-month loan, or what you might call a 3-month LIBOR, and what the U.S. government pays for a 3-month T-bill, that spread rose 63 basis points to 3.55%, which is the highest level that we've seen since 1984. And basically what it shows is an unwillingness of banks to lend to each other as they struggle to restore their own capital base. The failure of Lehman Brothers fueled fears if they put out these loans to other banks, they might not get repaid because the bank may fail, as Lehman Brothers did. The Fed will also expand their other TAF, term auction facility, by another $300 billion to bring that up to $450 billion. So the Fed is really pumping money out there. I'm sure their balance sheet has just gone down the toilet at this point. Basically, the efforts are there to help restore confidence in the capital and credit markets, and to get lending back on track, lending between these banks. In today's first contributor letter, the first sentence said, "The market is in an exceptionally dangerous place right now." And this was pre-market. This was sent out last night, late last night. Also, I said I'm seeing long-term accumulation. And we'll look at the spiders here. And this is a 15-minute chart of the spiders. I'm just going to zoom in a little bit. And this is my 3C indicator. And what we can see here is a failure over here, where this indicator should have been making new highs in yellow. So that was distribution. And over here we see accumulation building. We get a little bump, a little rally. And over here, again, we get another failure in this area where we should have seen a move higher. But all in all, if we stand back and look at this from the 18th and the 22nd, what we see is 3C moving up and price moving down. So this looks like longer term accumulation might be in play. Basically, I'm thinking there could be a rally within the next few weeks. Let's look at the Qs, and here's a 30-minute chart of the Qs. Again, we can see where this indicator should have been making higher highs with price. It failed over here, and we got a move down, a big move down. But now we're seeing lower lows, or higher lows, I'm sorry, as price goes down. So over in this area, which is about September 18th on, we're seeing accumulation, which is interesting. I wouldn't expect to see that. And here's the diamonds, which is the ETF for the Dow Jones 30. And again, something I wouldn't expect to see as we're making lower lows over here. I'd expect to see this indicator making lower lows, but no, we don't. We see higher lows. So again, this period between the 18th and actually currently, we're seeing what looks like some longer term accumulation. When I say long term, I mean a rally within the next week or two. Finally, let's look at XLF, which is the financials. And again, we see that same type of pattern. As financials are moving down, we see this indicator moving up, signaling again this period between the 18th and current looks like XLF, the financial ETF, is under accumulation in preparation of a move higher. On that letter that I also sent out, I also mentioned that there are some short-term negative divergences from Friday. Here's a 5-minute chart. And here's Friday's close. We can see Friday, a rally up. We would expect to see again this indicator making higher highs. Instead, it's making lower highs as price is rallying up. So this area over here is indicative of short-term distribution. Short-term because it's a 5-minute chart, which I took one of two ways. Either they're distributing in anticipation of some kind of large move down, or there's distribution just because they didn't want to hold over a weekend with all of the unsteady and uncertain news that could have come out of Congress's meeting. Here's the diamonds, which is the Dow Jones 30. We're going to look at the same thing on the diamonds, and we see again Friday's close in this area and this indicator making lower highs. So again, we have negative divergence, and over here, surprise surprise, we see what looks like positive divergence, which means the diamonds could be under accumulation here in this period from about 12 o'clock on, in anticipation possibly of a move higher. And here's the spiders, the SPY, which is the S&P 500. And again, we see the same pattern of negative divergence on Friday's close and a positive divergence today. Even though price is going down, that's why they're accumulating. They're buying shares on the cheap in anticipation of a spike or some kind of a move higher. And here's the Qs on the same 5-minute chart. Again, we see instead of this indicator making higher highs, it's making those lower highs as price is making the highest move of this period. And again, over here we see what looks like a zone of a positive accumulation